What if the price on your screen right now has absolutely nothing to do with the actual price being paid for silver at this very moment? What if $67.97, the number every chart, every ticker, every mainstream financial outlet is feeding you, is a fiction? Not a mistake. Not a lag. A deliberate structural fiction maintained by a system that is running out of the one thing it needs to survive: physical metal. That is the question nobody on financial television will ask you. And that is exactly the question we are going to answer in the next several minutes. Because what is happening inside the silver market right now, in the final days of March 2026, is not a correction. It is not a pullback. It is not healthy profit-taking. It is the visible fracture of a pricing system that has controlled the white metal for over 4 decades. And the data proving it is not hidden. It is sitting in plain sight on the CME Group's own depository reports, on the Shanghai Gold Exchange's own benchmark filings, on the LBMA's own lease rate disclosures. All you have to do is look. My name is OG John AG. This channel exists because the information you are about to hear does not get reported anywhere else in this format, raw, unfiltered, and built entirely on verifiable numbers. If that matters to you, hit the subscribe button right now. No pressure. But what I am about to show you might change how you look at every silver price quote for the rest of your life. Before we touch a single data point, consider this: 5 major banks have already been criminally charged and fined a combined $1.2 billion for manipulating the silver market. JP Morgan alone paid $920 million in 2020 and admitted wrongdoing to the United States Department of Justice. Scotiabank settled for $127.5 million. HSBC paid $76.6 million. Deutsche Bank paid $75.5 million. Morgan Stanley added another $1.5 million. All caught, all fined, all engaged in spoofing, flooding the market with fake sell orders to push prices down, then buying at artificially depressed levels. Between 2008 and 2016, these institutions systematically rigged precious metals through spoofing, price manipulation, and benchmark fraud. Regulators caught them. Convictions and settlements span from 2016 through 2025. That is not conspiracy. That is court record. And the question nobody in mainstream finance wants to engage with is simple: if it happened before, under sworn admission and criminal penalty, what makes you confident it is not happening right now? Keep that in the back of your mind as we walk through what just happened this week. Let's start with the price action. On March 25th, silver opened at $72.60 per ounce, up $2.47 from the prior session and over $38 from where it traded 12 months earlier. The trend was intact. Momentum was healthy. Then March 26th hit. Silver dropped for $0.85 in a single session, nearly a 7% move to the downside. The price landed at $67.75. By March 27th, there was a small recovery of 22 cents to $66.97. But zoom out and the picture is far more violent. On March 5th, silver was trading at $82.78. That means in just 3 weeks the metal has lost roughly $15 per ounce, an 18% decline. Pull the lens back even further, the all-time high was $121.67 set on January 29, 2026. Silver has now fallen nearly 45% from that peak in less than 60 days. So the obvious question every retail investor, every stacker, and every fund manager is asking is the rally over? Has the structural thesis broken? Were the people calling for triple-digit silver simply wrong? Hold that question. Because the answer lives inside 3 data sets that contradict the price action so completely, so violently, that you will need to decide for yourself which version of reality you believe, the paper version or the physical one. Data set number 1, COMEX Vault Inventories. As of the last reporting cycle, registered silver on the COMEX, the metal that can actually be delivered against futures contracts, has declined 11.5% in just the past 30 days. That is 10 million ounces withdrawn in a single month. The coverage ratio now stands at 13.5%, deep in stress territory. Paper leverage has risen to 7.4 times. For every ounce of deliverable metal sitting in those vaults, there are 7.4 ounces of paper claims floating above it. At the current pace of withdrawals, registered silver on the COMEX would be completely exhausted in approximately 170 trading days, roughly 8 months from now. And the drain is accelerating, not slowing. The April 2026 first notice day is now just 2 business days away. There are still 1,181 open contracts representing 9.9 million ounces. Those contracts either roll, settle for cash, or demand physical metal. Every single one creates pressure on a vault system that is already bleeding. Total COMEX silver inventory sits at roughly 440 million ounces. Sounds comfortable until you realize only 124 million of those ounces are registered, less than 30% can actually be delivered. Since 2021, registered silver available for delivery has declined by over 70%. Open interest on COMEX silver futures often represents 10 to 20 times the available registered inventory. If even 5% of contract holders demanded physical delivery simultaneously, the exchange could not fulfill those requests. In January 2026, 49.4 million ounces stood for delivery, more than 7 times what January 2024 generated. All of 2025 combined settled 474 million ounces, more than double the 203 million ounces settled in 2024. This is not a blip. This is a trend with a trajectory. The Sprott Physical Silver Trust doubled its capital raise program in January to $2 billion, enough to purchase roughly 18 million ounces at prevailing prices. That single institutional move represented approximately 16% of COMEX registered inventory. And silver has entered backwardation. Spot price is now higher than the futures price. In a normal market, futures trade above spot because of storage and carrying costs. When that inverts, it means immediate physical demand is so intense that buyers are willing to pay more for silver today than the market expects it to be worth tomorrow. Backwardation in precious metals is one of the clearest warning signals that something in the physical supply chain is breaking. So if the physical market is this tight, if the vaults are draining, if institutions are lining up to take metal off the exchange, then why is the paper price falling? Data set number 2, Shanghai. The silver price in China is not $67. It is not $72. Physical silver on the Shanghai market has traded at sustained premiums as high as $120 to $130 per ounce, a 40% to nearly 100% premium over COMEX quotes. In a functioning global market, that spread gets arbitraged away within hours. But the gap is not closing. It has been persistent for months. Why? Because China reclassified silver as a strategic material on January 1, 2026, placing it in the same regulatory category as rare earths. Export licenses are now granted only to 44 approved firms. China controls 60% to 70% of global refined silver exports. That pipeline has now been placed behind a licensing wall. The global silver market has effectively been split into 3 isolated islands: Asia, Shanghai, North America, COMEX, and Europe, LBMA. Each one is now pricing silver differently based on local supply conditions rather than global equilibrium. The arbitrage mechanism has broken because there is simply not enough movable metal to make the trades work. Data set number 3, lease rates. In a normal silver market, 1-month lease rates sit between 0.3% and 0.5%. By January 2026, that rate exploded to approximately 8%. During peak stress moments, it surged to more than 30 times normal levels. The LBMA saw its eligible silver stocks shrink to only about 155 million ounces by 2025, while floating annual demand runs between 900 million and 1.2 billion ounces. The paper-to-physical ratio has stretched as high as 356 to 1. That is not a market. That is a confidence game. Now, honesty requires looking at the other side. The bearish case exists, and it is not stupid. Silver has a history of vertical rallies followed by violent collapses. The Hunt brothers in 1980. the parabolic run to $49 in 2011. Both ended with margin hikes and prices cutting in half or worse. On January 7, 2026, the CME raised silver maintenance margins to $30,500. That triggered forced liquidations. The 34% single-day crash on January 30 wiped out over $3 trillion across gold and silver combined. There is also a massive short position reportedly built by a billionaire Chinese trader on the Shanghai Futures Exchange. The SLV ETF saw $14.3 billion in single-day volume near the peak, classic blow-off-top behavior. Higher rates, geopolitical tension with Iran, and risk-off sentiment are real headwinds. But here is what the bearish case cannot explain: the vault drain has not stopped. Delivery demand has not slowed. The Shanghai premium has not closed. Lease rates have not normalized. And the supply deficit is not getting smaller. The Silver Institute confirms 2026 will mark the sixth consecutive annual market deficit. Cumulative shortfall from 2021 through 2025 stands at nearly 820 million ounces. 2026 supply is estimated at roughly 1 billion ounces. Demand is projected at 1.18 billion ounces, a 180 million ounce gap. Industrial demand alone hit a record 680.5 million ounces in 2024. Solar, EVs, and new government mandates are driving that number higher every single year. JP Morgan Global Research sees silver averaging $81 per ounce in 2026, more than double its 2025 average. The gold-to-silver ratio currently sits near 64.6, compressed from over 100 in April 2025. Institutional capital is rotating from gold into silver at a scale we rarely see. While the paper price says $68, the physical market is saying something the paper system cannot afford for you to hear. So the real question is not whether silver is going up or down next week. The real question is this: if the paper market and the physical market are telling two completely different stories, and one of them has to be wrong, which one are you betting your financial future on? The one backed by warehouse receipts and futures contracts that outnumber real metal 356 to 1, or the one backed by bars being loaded onto trucks in New Jersey, shipped to vaults in Shanghai, and locked behind a government licensing wall that did not exist 90 days ago? That answer is something you have to decide for yourself. But at least now you have the data to make the decision with your eyes open. If this changed how you think about silver even a little, share this with one person who needs to see it. Drop a like so the algorithm pushes this to more people who are not getting these numbers from mainstream financial media. And if you watched this far, you already know you are not a casual viewer, you are part of the minority that reads the vault reports while everyone else reads the headlines. Prove it. Drop the words OG John AG 2.0 in the comments right now. When I see that phrase, I know exactly who stayed until the last word. Invest with logic, never with noise. OG out.